Welcome to the Finance Savvy, your trusted source for all things personal finance, wealth management, and financial wisdom. Here, we believe that financial success is within everyone's reach, and we're here to guide you on your journey. Our channel is designed to empower you with the knowledge and strategies you need to make informed financial decisions. We provide tips, tricks, and insights to help you achieve your financial goals, whether it's budgeting, investing, or planning for the future. Join our growing community of financial enthusiasts. Subscribe now and ring the notification bell so you never miss our valuable updates. At the Finance Savvy, we're dedicated to making your financial dreams a reality. Let's embark on this journey together. Welcome to a segment that could make a significant difference in your debt management journey: negotiating with creditors. If you're struggling to make payments, understanding how to approach these conversations can be a game changer. We'll explain the strategies and potential benefits of negotiating with creditors. 1. The power of negotiation. Negotiating with creditors is a powerful tool for those experiencing financial hardship. Here's why it's crucial. 1. Reduced interest rates. Through negotiation, you may be able to secure lower interest rates on your outstanding debts. 2. Lower monthly payments. Negotiating can result in lower monthly payments, making it more manageable to stay current on your debt. 3. Avoiding collection actions. Successful negotiation can help you avoid the adverse consequences of missing payments, like collection actions and damaged credit. Here's a question from the audience.
The above statements, reduced interest rates. 1. Through negotiation, you may be able to secure lower interest rates on your outstanding debts. 2. Lower monthly payments. Negotiating can result in lower monthly payments, making it more manageable to stay current on your debt. I have never negotiated with a creditor before. How do you negotiate with the creditors to reduce your debt? Do the creditors lower your debt?
Negotiating with creditors to reduce your debt is a process that can be successful in some cases, but it's important to understand how it works and what to expect. Here's a general outline of how to negotiate with creditors. Contact your creditors. Start by reaching out to your creditors directly. This can be done by phone, email, or in writing. Explain your financial situation and the challenges you're facing. Be prepared to provide details about your income, expenses, and the specific debt you're trying to negotiate. Explain your situation. Clearly communicate your financial hardship. Whether it's a loss of income, medical expenses, or other circumstances, your creditors need to understand why you're struggling to meet your current obligations. Propose a repayment plan. Offer a proposed repayment plan that you can realistically manage. This may include a reduced monthly payment, a lower interest rate, or an extended repayment term. Creditors are often more willing to work with you if they see a structured plan in place. Be polite and professional. Maintain a respectful and professional tone during your negotiations. Creditors are more likely to cooperate when they are treated with respect and when you demonstrate a sincere intention to fulfill your obligations. Get agreements in writing. If your creditors agree to new terms, request written confirmation of the agreement. This documentation is crucial for your records and protection. Consider professional help. If you're uncomfortable negotiating on your own, or if you're dealing with multiple debts, you might consider seeking assistance from a reputable credit counseling agency or a debt settlement company. They can negotiate on your behalf, but be cautious and research their fees and reputation. Know the limitations. While creditors may be willing to negotiate lower interest rates, extended payment terms, or smaller monthly payments, they typically won't lower the actual debt amount owed. It's more about adjusting the terms of repayment. Stay committed. Once an agreement is reached, it's essential to honor the new terms and make timely payments as per your agreement. Failure to do so could void the negotiated terms. Negotiating with creditors can be a successful way to make your debt more manageable, but it's not a guarantee. Some creditors are more flexible than others, and the outcome may vary based on your individual circumstances. If you're struggling with debt and considering negotiation, it can be helpful to consult with a financial counselor or attorney for guidance specific to your situation. 2. When to consider negotiation. Knowing when to consider negotiating with your creditors is essential. Here are some scenarios where it's appropriate. 1. Financial hardship. If you're experiencing genuine financial hardship due to job loss, medical expenses, or other unforeseen circumstances. 2. Missed payments. If you've missed payments and fear falling further behind, it's a good time to reach out to creditors. 3. High-interest debt. If you have debts with high interest rates, seeking lower rates through negotiation can significantly benefit you. Here's another question from the audience.
This statement, quote, high-interest debt. If you have debts with high interest rates, seeking lower rates through negotiation can significantly benefit you, unquote. So, the creditors can put your interest rate as high as they want, and they can also lower your interest rate to where they want. Do the creditors don't use the bank's interest rates?
Creditors typically have some flexibility in setting interest rates, especially with unsecured debts like credit card debt. Here's how it generally works. 1. Initial interest rates. When you first open a credit card account or take out a loan, the creditor will set an initial interest rate. This rate can vary based on your creditworthiness, the type of debt, and market conditions at the time. 2. Variable versus fixed rates. Credit cards often have variable interest rates, which can change periodically based on factors like the prime rate. Loans, on the other hand, may have fixed interest rates, meaning the rate remains constant for the duration of the loan. 3. Creditors' discretion. Creditors have some discretion in setting and changing interest rates. They can increase your credit card's interest rate if you miss payments or if market conditions change. However, there are regulations governing how and when they can do this, such as the Credit Card Act in the United States. 4. Negotiation. While creditors have their standard interest rate policies, they may be willing to negotiate interest rates under certain circumstances. For example, if you're facing financial hardship, you can contact your credit card issuer and request a lower interest rate. They may or may not agree to your request based on your payment history, credit score, and the nature of your financial difficulties. 5. Market interest rates. Creditors are influenced by market interest rates to some extent. For instance, the prime rate set by central banks can impact the rates offered by credit card issuers. However, your creditworthiness remains a significant factor in the interest rate you're offered. So, while creditors have some flexibility in setting and negotiating interest rates, there are limitations and regulations in place. They often consider your credit history, payment behavior, and current financial market conditions when making these decisions. Additionally, different creditors may have varying policies regarding interest rate negotiations. If you found this segment informative, please hit that spinning subscribe button and subscribe to our channel. Thank you. 3. Negotiation strategies. When negotiating with creditors, consider these strategies. 1. Be prepared. Have a clear understanding of your financial situation, including your income, expenses, and the amount you can realistically afford to pay. 2. Contact creditor early. Reach out to your creditors as soon as you anticipate trouble making payments. Early communication demonstrates responsibility. 3. Explain your situation. Be honest about your financial hardships and provide a brief explanation of the circumstances that led to your current situation. 4. Propose solutions. Suggest potential solutions, such as lower interest rates, extended payment terms, or reduced monthly payments. 5. Be persistent. Be prepared for negotiation to require multiple conversations. Persistence can pay off. 4. Potential outcomes. Negotiating with creditors can lead to several potential outcomes. 1. Interest rate reduction. Creditors may agree to lower their interest rates, reducing your overall debt burden. 2. Extended terms. They might extend the repayment period, resulting in more manageable monthly payments. 3. Settlement offers. In some cases, creditors may offer a settlement, allowing you to pay a reduced lump sum to satisfy the debt. Another great question from the audience.
The above statement, quote, interest rate reduction. Creditors may agree to lower your interest rates, reducing your overall debt burden, unquote. Creditors usually agree to lower the interest rate for you to be able to make the payments. However, in some cases, they cannot lower your interest rate and you cannot make the payments. What would you do?
If your creditors cannot or will not lower your interest rate, and you're unable to make the payments, you have several options to consider. 1. Seek financial assistance. Contact a reputable credit counseling agency. They can provide financial counseling and may be able to negotiate with your creditors on your behalf. They can help you create a budget and explore debt management solutions. 2. Debt consolidation. Consider debt consolidation as a way to combine multiple high-interest debts into one loan with a more manageable interest rate. This can make payments more affordable and simplify your financial situation. 3. Debt settlement. In some cases, you might negotiate with your creditors to settle your debt for a reduced amount. This is typically a lump sum payment that's less than the total debt owed. Be aware that this can hurt your credit. 4. Bankruptcy. If you're facing extreme financial hardship and other options are not viable, bankruptcy may be an option to consider. Chapter 7 and Chapter 13 Bankruptcy can provide relief from overwhelming debt. Consult with a bankruptcy attorney to explore this route. 5. Legal assistance. Consult with an attorney who specializes in debt and financial issues. They can provide legal advice and guidance on how to address your specific situation. 6. Consumer protections. Be aware of consumer protection laws that may apply in your jurisdiction. These laws can limit what creditors can do to collect debts, and they may offer you some relief. 7. Review your budget. Continuously review your budget and look for opportunities to reduce expenses and increase income. Even small changes can make a difference. It's essential to communicate with your creditors about your financial difficulties and explore your options. In many cases, creditors are willing to work with you to find a solution that allows you to make manageable payments. However, if your financial situation is dire, it's important to seek professional assistance and explore the full range of options available to you. Each individual's financial circumstances are unique, so the best approach may vary from one person to another. 5. Document everything. When negotiating with creditors, always document your conversations. Keep records of who you spoke to, when, and what was discussed. This documentation can serve as proof of agreements made during the negotiation process. In conclusion, negotiating with creditors is a vital skill when managing debt, especially during financial hardships. It can result in lower interest rates, reduced payments, and a path to financial recovery. The key is to be proactive, honest, and persistent when communicating with your creditors. Stay tuned for the next segment, where we'll explore debt management apps and tools, which can help you organize and track your financial obligations. If you found this segment informative, please like and subscribe, and remember, when it comes to debt management, effective communication can make all the difference.